Adjusting entries are one of the most difficult concepts in Accounting 263, and they're required to ensure that the revenue and expense recognition principles are followed. So we're going to look at the impact of adjusting entries on the accounting equation, and keep in mind that you are not responsible for knowing debits and credits in Accounting 263. So let's take a look at supplies as an example. Now, it wouldn't be feasible for a business to record an expense every single time supplies are used. So for example, if someone comes and grabs a stack of Post-it notes out of the supplies closet, the accountant doesn't want to have to increase supplies expense for $1 for every single time supplies are used. So instead, what we do is we increase the asset account supplies when supplies are purchased. And then right before financial statements are prepared, we adjust the asset account supplies to recognize an expense for the amount of supplies used. So let's say, for example, that we paid $2,500 cash for supplies on January 1 in our business. Well, how the accounting equation would have been impacted by that transaction is one asset account, supplies, would increase, while another asset account, cash, would decrease by $2,500. But our accounting equation is still in balance because we have a comparable increase and decrease on the left side of the equation. Now on March 31st, right before we prepare quarterly financial statements, we're going to take an inventory of our supplies. So we go out to see what dollar amount of supplies are left, and we see that there are $1,000 worth of supplies remaining in our supplies inventory. Well, since we had purchased $2,500 worth of supplies and only $1,000 are left, we're going to assume that $1,500 worth of supplies were used. So we want to recognize the supplies expense because we've incurred that expense in the first 3 months, and so we need to recognize it. We also need to reduce the amount in our asset account, the supplies account, because right now it shows we have $2,500 worth of supplies, when in fact we only have $1,000 worth of supplies. So we need to decrease our asset account, the supplies account, and we need to recognize the expense for the supplies that we've used. So we also need to decrease our equity account, since expenses reduce equity. And when we're going to do this through an adjusting entry. And this adjusting entry ensures that the expense recognition principle is followed, where we're recognizing our expenses when we incur them. Now, supplies, they're an example of a prepaid expense. So we're paying for the supplies first, but we're going to wait to recognize the expense until we actually use the supplies. So that's why it's called a prepaid expense. So we're paying for the expense before we actually recognize it. And remember, we do it this way because it's not practical to recognize an expense every single time we use a supply. So we're just going to wait until we're ready to prepare financial statements to make these adjustments. And by the way, what we use as a reference in determining the amount of our adjusting entry is the trial balance. And that's where we list all of the accounts on both sides of the accounting equation, and we make sure that all of the asset accounts equal the total of the liability and equity accounts. And then accountants look at the balances in the trial balance to determine which accounts need to be adjusted. So accountants would look at the supplies account, for example, to determine the adjusting entry for supplies. Here's another example, prepaid insurance. This is another type of prepaid expense. So let's say a company pays $600 cash for a 1-year insurance policy, and it purchases the policy on October 1. Well, prepaid insurance is an asset to the company because it has future value. So we're going to record that transaction when the policy is purchased as an increase to prepaid insurance, an asset account, and we'll also record the decrease to cash. And so in this initial transaction, you can see that after we record the transaction, our accounting equation is still in balance. Then let's say that we want to prepare financial statements as of December 31st, which is 3 months later than the date in which we purchased the 1-year insurance policy. So we need to prepare an adjusting entry as of December 31. We don't want to leave that prepaid insurance asset with a balance of $600 because that would not recognize the fact that we've actually used up some of that insurance policy. So we need to decrease the amount of the asset since we've used some of it up, and we also need to recognize some insurance expense. So we would actually prorate it, and if we paid $600 for 1 year or 12 months of insurance, 600 divided by 12 is equal to $50 a month. So we need to recognize 3 months of insurance expense, or $50 times 3, $150. So we need to record an adjusting entry that will decrease the amount of prepaid insurance by $150 and recognize insurance expense of $150. So our adjusting entry, after we make it, will result in our fairly stating the value of that prepaid insurance on our balance sheet, and it will recognize the $150 of insurance expense that has been used up and incurred in our business. Here's a quick tip. An adjusting entry always includes one income statement account and one balance sheet account. And before we make the adjustment for prepaid expenses, our assets are overstated and our expenses are understated. So for example, going back to the prepaid insurance, if we didn't make the adjusting entry recognizing the 3 months of insurance expense that had been used up, our prepaid insurance account would be overstated on our balance sheet and our expenses would be understated. So the adjusting entry corrects this and correctly states both the balance sheet and the income statement.